Welcome to the Long Only Podcast. I'm Doug.
Gerry,
Gerry, how is it going today?
it is going well.
Excellent.
It is going quite well.
Well, why is it going so well?
The inflection that we talked about last time
Yes.
was inflected.
Yes.
They rang a bell, and the Fed got a clue that they probably have gone too far in interest rates and have now signaled that they're going to be lowering rates. And I honestly don't know why. I mean, I know there's all these discount models that value companies and there have been past periods of inflation, nothing like this in 40 or 50 years, granted, but past periods of inflation, higher interest rates where growth companies' stock prices did not get hit like they did this time around. Then again, they also had this ridiculous run in the 2020, 2021 era. So, our time frame. So, yeah, obviously it has something to do with that, but nonetheless, it does look like inflation has peaked. Don't get excited. That doesn't mean prices are going to go down to back where they were before COVID. You're still going to pay, $25 for a deli sandwich, at least for the foreseeable future. But it does look like the inflection point has been hit. And I hate talking about the Fed, but it's the focus on it has been so ridiculous. It's like you can't ignore it. You can't not talk about it. Hopefully, we will get back to some semblance of normalcy. It does feel like that inflection has happened. I mean, we've had, without getting into numbers, the growth company portfolio has had quite a few days here where, I don't know, 4 times the return on the market. So, I mean, which is in and of itself ridiculous. But this is the world we live in today. Embrace it, learn to live with it. It's the hand we've been dealt. We just have to play it.
In this segment, we're going to call not just crowing about how we appear to be right so far. I mean, let's face it, we're not that far into this. We've been fooled before. The difference is that this time the market kind of has the Fed's permission to go up due to the recent meeting. There's a little more.
Don't be surprised if they jawbone it back down again because they don't like seeing it. But I think the positive, and this is where I think I'm going to get into what we really wanted to talk about today. The positive is that it's not necessarily that the market, quote unquote, has done all that fantastic in the last couple of days. What we've seen is just finally growth company stock prices have been, acting really well where they haven't for 2 years. Almost to the day. I mean, it was November of 21, and it was about 4 weeks ago, so maybe halfway through November, that the first real inklings after what we've talked about, like the 7th time we saw our growth portfolio hit a low, the same basic low for over 2 years, unprecedented as I can recall. So it was about 4 weeks ago that this started, and then the inflection has happened. The Fed made their comments this week that they're recognizing the inflation numbers have been acting better, and that lower interest rates are on the horizon down, into 24. And I think that the market is discounting something like 75 or 80 basis points of lower rates. The next probably shoe to drop is, and we're already starting to see it, is economic numbers being worse than it, hoped for. I still think there's a good chance that we could end up avoiding an all-out recession, but nonetheless, economic numbers looking worse than they are expecting, and then there might be a much quicker and more rapid drop in rates, which, again, I don't like. And this volatility and this focus on Fed and interest rates is insane. Let's get some policies in place that will actually promote growth, and then inflation will take care of itself. Growth will take care of itself. Stock prices will take care of themselves. Value will migrate to real economic value as opposed to the nonsense we've seen, frankly, for a couple decades. But we won't get into that today. What we want to get into is what, Doug?
I get to say the title.
Okay. Oh, you get to say the title.
I get to say the title.
Didn't I say what do we want to talk about, Doug?
We're going to talk about positioning yourself for a rally in growth particular, but a market rally. You're going to correct me on the term market rally because you just said before we started recording.
Well, I think it's really important. I don't know that enough people have an appreciation for the common term when we say the market. I think it's fair to assume or fair to say that most people think of the Standard & Poor's 500 stock index as the quote unquote market. Whether that's adequate or not, we can argue from here to eternity. We'd have 150 podcasts on that. What I think most people don't understand is in a market capitalization weighted index, there's a mouthful,
such as the S&P 500.
such as the S&P 500, which means the largest valued companies, in other words, the biggest market capitalization, which is another term for the valuation of a company, the largest get the most weight in the index. And right now, we keep hearing about this Magnificent Seven, and I can never get it right. What is it? Facebook/Meta.
I don't know. Tandy, MCI WorldCom, all the big ones.
Yeah. Now you're talking about the nifty 50 of the 70s. Although, yeah.
We got Facebook, Netflix, Google, Amazon, Apple, Meta, Tesla.
I don't think Netflix is no longer in there. Netflix was the FANG, but it didn't make it to the Magnificent Seven.
Oh, you're right. 2 days ago, NPR, my source for all things news related, and really truth itself, NPR, Apple, Amazon, Alphabet, NVIDIA, Meta, Microsoft, and Tesla. So yeah.
There you go. So those 7 companies have represented 30% roughly of the move in the S&P 500. I guess over the last year, that's probably been the case over the last 2 years or something close to that. 7 companies. I mean, when we say S&P 500, they're actually using 500 different companies in that index. But because of the market capitalization weighted aspect of it, and because we're dealing with companies that are measured in trillions, Apple, I think, is the biggest at 3 trillion or thereabouts. Am I right? I don't know. Close. I don't think enough people have an appreciation for how much that is, quote unquote, the market right now. Really, 7 companies, 7, not 500. So, and we've talked about this phenomenon before, and I think it's almost, I mean, when you get to I don't have the exact number, but when you get to like the top 10, it closes in on 50%. When you get to the top 25, it's almost the whole darn thing. And these are the largest of the largest companies. And there's no doubt in this environment of heavy-handed government, this environment of higher interest rates and inflation, this environment of high taxation, we've ended up with the largest of the companies, the incumbent. It's benefited incumbency. So it's benefited the large S. Might that be changing? I don't want to go out on a limb and say that, certainly from a policy standpoint. But what I think is happening at the very least is the quote unquote valuation mechanisms, the models, if you will, the algorithms that are out there running around and churning every day, valuing companies, probably now turns in favor of the growth side of the equation. Not to mention, if we do end up in a more recessionary environment, that's not going to equal heavy parts of the index or the indices that will be hurt more by an actual recession. Again, I still don't think that's necessarily going to be full blown. I think we're in a normal market or in a normal economy, and I don't know that we have one and haven't for a long time. But rolling recessions happen all the time. What do I mean by that? I mean, certain industries will be in recession where others are doing well. That's actually pretty normal. And most quote unquote macro recessions, I'm using these.
Yep. I got you.
Policy driven. They're policy driven, usually monetary policy driven. They make a mistake and it causes this, sort of almost systemic type of move. So I think that, just to wrap up on this segment, I think we've seen an inflection point. I don't like the violence of the up move, frankly, but that's going to be what we live with. Don't be at all surprised if 2 years from now we've seen this massive outperformance on the growth side of the equation. Just if nothing else, from what so many of the mathematicians like to refer to as a reversion to the mean taking place.
Well, okay, but you've diagnosed what's going on, but what's the prescription? Because we want to make sure if we're exposed for a market rally, is the answer simply check your exposure, because if you're buying those broad indices, it could be you're much more dependent on those large companies than what you think.
That number one. And number two, if you've raced to cash because they're paying 5% in the money market fund now, get ready for that to collapse back down. And I really hope we don't end up with 0% interest rates, but don't be surprised if that happens if we have a calamity economically. So, but the 5% money market fund is probably now a thing of the past for a while. Is inflation forever and always dead? No, because it never has been. It wasn't in this period of quote unquote disinflation we had for 3 decades or so. Inflation at 2% is still a problem. We would prefer inflation to be zero. That's not the world we live in. We live in a fiat world. We live in a central banking world. That if that's the case, we're going to have inflation. It's going to be more subdued. We move back towards the trend of 2%. Sadly, that's also the trend that we have in the economy. It's a 2% economy instead of a 3% economy, and that's because of the poor policy and the poor, overall, landscape for economic growth is not as favorable as it was, say, for example, throughout the 80s and 90s. That's the 1980s and 90s.
So are you suggesting, basically, it seems to be what you're saying, if I know you the way I think you are, is that small cap stocks have more room to grow, and these large income, not these large,
or large cap, but smaller companies that are not the most gigantic of the gigantic. If you stripped out those 7, the market really hasn't done very well in the last 2 years. I mean, it did poor. It was, I think the S&P was down, I don't know, like 18% or 20% in 2022. But then this year, back up over 20% on the index. But that's largely driven by the biggest of those companies. If you look deeper down into the index, they haven't done as well. A good way of seeing this is there is out there, and I don't have the exact number, but I bet a lot that I'm right on this. I'm sure this is the case. The equal weighted S&P 500 has done has done poorly probably compared to the market cap weighted. I think that's for sure. I'll have to look now. I should have looked before we got on this, but.
Well, it would stand to reason, because we know that the Magnificent Seven form a large part of the gains.
Yes, 30.
Of the S&P. So, and I will say this: if you take a look at the charts, this is not advanced charting. I'm not predicting, but the S&P is not that far off of all-time highs. We're talking about a few percentage points or fraction points. Pardon?
I think Dow just made an all-time.
It might be. It's within a hair, if not there. But the Russell 2000 is probably a good 20% off an all-time high.
Yeah.
So it's so again, if you're talking about what has more room to move,
percent off an all-time.
Pardon?
Yeah, we're still probably 30% ish off.
Yes, as a firm, yes.
Yeah.
So
on our growth portfolio.
Yes.
Yeah.
On our core growth portfolio. So again, check your asset class mix, and also, if you want to be prepared, I would also say get out of cash, because you're not going to have a plan to do that, because you're not going to pick the exact right time to do it. Probably never should have been in cash to begin with. And if you've
been blessed enough to be in cash and missed some of the downs in the market over the last couple of years, then you should start nibbling back in.
Correct. You got one right, take the win, but don't wait for that perfect time to get back in, because it's not going to happen. Right. So develop a plan, whether you just want to go all in or whether you want to start legging in, which is generally easier psychologically for most people. So.
Yes.
Going to put a bow on that segment?
Yep.
All right. Okay. To avoid saying all right.
Okay.
The next we are going to talk about a personal finance topic. And I think, Gerry, this is something we've only talked about very roughly, you and I together. So I'm interested in your reasons. But as people are trying to get their affairs in order for the beginning of the year or the end of the year, however you want to look at it, because based on my calendar, the beginning of one year is the end of another. So I don't know. But yes, it does work out. It's a circle of life. But Gerry, life insurance. If people depend on you, you need life insurance. And we're not life insurance brokers. I've had a life insurance license in the past. Wasn't something I ever made a ton of money on. You have some, what I think, based on what I've talked to you about, you have some counterintuitive thoughts on it. Life insurance, I think.
The age-old investment person's argument is buy term and invest the difference and avoid whole life insurance. I don't buy into that. I do think that for a young person, because risk avoidance is the most important aspect of insurance for a young person, then term does need to be a component of it. So, for example, if you're a father or mother of a young children,
Let's say six. Let's say you have 6 kids, Gerry.
6 kids like Doug,
Yeah.
you absolutely need to have, life insurance, especially if you're the primary breadwinner. And my rule of thumb is I want to create if horrible happened, I should meet an early demise. I have kids and a wife, and I want to make sure that I'm setting them up. Not just I don't want them to be in a position where they just a common rule of thumb is get life insurance to pay off debt like a mortgage and what have you. No, because that's not a smart thing to do. But what I do want to do is allow them to have a pool that will be able to generate a close approximation, not necessarily depending on how affluent and how well you've done, not necessarily suggesting you have to replace every bit of income that you have, but a reasonable level of that income to be able to be replaced with a pool of money. So when you're young, term life insurance is very cheap. All life insurance is cheap relative to when you get older, obviously, and you take more of a risk that you might end up with some sort of pre-existing condition that precludes your ability or limits your ability or maybe erases your ability to be able to even get life insurance. So you want to make sure you've got enough term life insurance to replace at least a good portion, and maybe a rule of thumb is pick a number between 50 and 75% of your current income. But we're also big proponents of whole life insurance the younger you are. And you might say, well, why is that? Because aren't you putting that money into the black hole of the insurance company? The answer to that is yes, you are. But you're also generating a permanent asset that has a certain amount of leverage to it. I mean, if you buy whole life insurance and you die tomorrow, if you buy any kind of life insurance and you die tomorrow, you die tomorrow. You buy the life insurance, you die tomorrow.
Well, you buy the farm tomorrow.
You buy the life insurance and then you buy the farm tomorrow. The leverage that gives you is far more than any investment could ever give you. Okay, and that continues to be the case over time, even though by definition it decreases. As the more you're paying in premiums, the less that leverage is, but it's still leverage. There's a reason why you can go out and probably search online for articles. There were some good ones over the years about Warren Buffett's belief in whole life insurance, and I have plenty of issues with Warren Buffett, but that one I agree with him on.
Perhaps the only thing you agree with Warren Buffett.
One of the only things. That's not totally true, but anyway, why did he have so much whole life insurance? Well, it's permanent. It doesn't go away. It lasts until Charlie Munger died at 99. His life insurance paid off. Term life insurance, by its definition, goes away.
Well, he had 75-year-old kids who were still depending on him. So,
yeah, really. The permanence and definition of whole life insurance is important. The other thing is it sort of doubles as a kind of alternative asset class, in that as you go on or you go along, the premiums are always there. So it's perceived to be expensive because they're much higher premiums. The younger you are, the lower they are. So it's valuable to get involved earlier in your life because the premiums are more palatable. But what's happening is after a few years and I'm talking about you need to be with the reputable firms, the really good firms. And by the way, as Catholics, we have the Knights of Columbus. Knights of Columbus were put together for the very purpose of providing insurance for the
Knights of Columbus put a hole in my arm because I needed more
There you go.
insurance today.
Life insurance from Knights of Columbus.
Yep.
They were created for the sole purpose of building a pool for the widows and orphans of the miners in, I think, Pennsylvania. They are probably one of the best, if not the best, life insurance companies out there. You do have to be a knight to get it, but excellent. They're very, very well run. Great experiences with returns. If you're a knight, definitely. I mean, if you're a knight, you have the insurance. That's just all there is to it. Another really good one's Guardian. There are other good ones out there. And I definitely tend to lean more heavily towards the mutual life insurance companies as opposed to ones that are publicly traded. Just a little better cost structures. Anyway, but you want to make sure you're getting a really good. There is a difference in a well-run and well-organized and well-managed life insurance company, because you are putting your money into that black hole. They're investing it, but they have, it's actually a beautiful business. I've thought about it many times. It's like, gosh, I wish I could be in the life insurance business, because they truly have a long-term investment perspective, and they're investing in everything, real estate, stocks, bonds, whatever. It's a well-diversified, well-thought-out strategy. And if it's well-managed, the dividends that the whole life policy pays are very good and consistent. And it is alternative to what we're trying to do on the growth side of the equation, in that it tends to be, it's there in difficult times. And I look at it, especially after you get past the first few years on a policy and you're continuing to make the premiums, it's really just a savings account. And, it used to be called, the life insurance sales guys would call it, forced savings, because people don't save on their own. And you know what? That's actually true in many cases. A lot of times the only thing people have are their 401k and the cash value in their whole life insurance policy, as sad as that is. We obviously advocate for not just doing that, but nonetheless, that is a valuable tool. You can borrow against it, and the cost of borrowing, because you're still getting dividends while you're borrowing, is much less than when you're out borrowing in other ways. So that savings aspect of it is there, because as time goes on and that cash value builds up, if you need to use money for whatever purpose, you can go in there and just do a policy loan. Check with your tax advisors to make sure that everything is, all squared away as far as the taxability. It shouldn't be taxable for most people. As the policy ages and so much cash value builds up, there could be some tax implications if you take a loan. But big proponents for a younger person of a combination of whole and term. And then as you get older and you don't have the same responsibilities with a family, I'm in this right now. I still have term insurance. It's still, not quite run out yet. I think I did like 20-year term somewhere back, and maybe it has 5 to 10 years left. You can let those lapse. You rented insurance for X number of years because you had the risk, and you wanted to make sure you didn't. But then you have adult children that are out working and doing their own thing. You don't need that anymore, but you keep your whole life because it's permanent and it's there forever.
All right, Gerry, I have some thoughts on this. Okay.
Yeah.
So, and since I have a hole in my arm from an insurance test today, I get extra weight for my thoughts. But I have whole life too, and term. I would say stream of consciousness, a couple things. If you look at compensation for wealthy people, the research I've done indicates you'd be surprised at how much life insurance factors into their compensation and benefits from work. So consider that. Number two, people like to poo-poo on whole life insurance. I think a lot of that is due to overzealous whole life agents making overly bold, audacious claims about life insurance returns. Don't compare it to the stock market. It's different. It's more conservative, I would say. Number three, if you're concerned about what to get and you have young people, the young people depend on you, and a spouse depends on you. Don't overthink it. At least go out, get term. If you're married and you have kids and you're not independently wealthy, you need at least term insurance, and you can get it for, probably $100,000 worth of coverage. It costs you probably $100 a year. So most people, most wage earners will probably need upwards of $1 million. So you're looking at $1,000 a year. That's perfectly reasonable. And so don't overthink it. Don't spend a lot of time looking at what Dave Ramsey said about a whole life insurance versus what Gerry Forgot said. Just go get your term.
Mm-hmm.
then investigate the benefits of whole life insurance. Because
also need to emphasize that when it's it doesn't need to be the whole life versus term. They go together depending on where you
yep.
are in your life cycle. And you're right about the experience of returns on the whole life policy. But again, I'll emphasize it matters who's the insurance company. There's also this hybrid of, known as universal life, and we would avoid that because those are where a lot of those hyper sales type things come in and say, oh, you can earn have an index to the S&P 500 and earn a higher return, and isn't that great and wonderful? And most of those illustrations, they virtually all run out at a point that's not permanent. Really, it's this hybrid. Stay away from those kinds of things. Keep just pure, basic, simple whole life that you can add riders like long-term care insurance riders. There's all kinds of tools that you can use. You can have like terminal life riders where in an unfortunate situation where you might be diagnosed with a terminal illness, you can access death benefit. There's all kinds of things that come along with the whole life that make it beneficial. And I think it does. It needs to be an important part of every financial plan. And I'll leave you with, there's a reason why the wealthiest of the wealthy people have whole life insurance. One last thing though, when you talk about overzealous sales from the insurance side of the equation, probably one of the places where whole life insurance, I think, has been most maligned, rightfully so, is in these second to die scenarios that are out there. The insurance industry tried to sell this whole thing about second to die. You buy a life insurance policy and it's cheap because it pays off second to die. It's exact opposite of what you want. You want first to die. You want to get that big leveraged pool of money that comes from a life insurance policy at the first death. But artfully designed in a good estate plan, life insurance actually also becomes important when it comes to estate tax payment and how you structure that. So we won't get into that today because that's for certainly, it's a much more, it's a wealthy person's problem or issue, and it's much more in depth. But those are other reasons, other parts of the equation. And again, I just emphasize there's a reason why wealthy people use whole life insurance. So that should tell you something. And most insurance wants to sell you the term. Why is that? Because it's.
I know. I have an answer. Isn't it that like 99% of term policies don't pay out?
Correct. It's a boon to the insurance company. It's an absolute boon. You're renting, and they want you to live for that 15 years, and they get nothing but premiums and never have to pay a dime. Anyway,
and I will say this: if you're looking for Gerry's life insurance license on the wall behind him, you won't find it. So he's giving you. He's giving sincere advice. He doesn't sell life insurance, so he has nothing.
Sell any kind of product.
Yep. So, well, we are going to put a bow on the insurance again. In summation, if you have people who depend on you, you need some insurance, and you need insurance that's going to make sure they're going, not just checking a box. If you've got a wife and kids, $100,000 of insurance is not going to go very far. So you need enough insurance. Make sure you get the need covered. Moving on, Gerry wants to talk about one of his favorite things in the world, derivatives.
What is a derivative?
Well, and it's really not his favorite thing in the world, but this is our investing primer, our investing discussion of the week. What is a derivative?
It's a much maligned instrument. All it simply is, by its name, is it's a contract of sorts that's based on some underlying either commodity or stock or those two would work just fine. Probably the historically best example of what a derivative is the forward contracts in the agricultural world, where farmers put their whatever their crop is in the ground, and it's not going to come up until maybe they plant in the fall and it comes up in the spring, so 6 months later, and they want to lock in whatever the prices are. Say they're growing corn and they want to lock in the price that you're getting for corn now, but they're just planting. It's not going to be coming out of the ground for 6 months or however long it takes corn to do it, from fall to spring, let's say. And they will enter into a forward contract, which is a guarantee that they will be delivering X amount of corn for the specified price in the fall. That is a form of derivative. The futures market was born in the agricultural forward contract world. There's a reason why the Chicago Board of Trade is the most, what historically was the most popular commodities trading exchange and futures exchange, because it was all based on, sugar, corn, wheat, pork bellies, and then the Chicago Mercantile Exchange moved on to copper, gold, silver, the platinum, palladium, the various metals contracts. So all a derivative really is a contract for future delivery of something. Could be like I said, could be a block of gold. It could be a bushel of corn. It could be a pound of sugar. And those derivative contracts then migrated to stocks, where you would have a derivative contract on a stock, and that's a form of derivative on stocks would be the famous puts and calls. You buy a put when you think something's going to go down because it's an agreement to sell at a certain price. You buy a call when you think things are going to go up because it's an agreement to buy at a certain price. So if you think the price is going to go up, but you don't want to buy the stock, and you think it's going to go up over a 6-month period of time, you'll buy a call option because it's guaranteeing the price today, kind of similar to what the farmer did for delivery of that stock in the future. That's all it is. It's been much maligned. There's nothing in and of itself that's evil about derivatives. It's just the use of derivatives has tended to get out of control. When you start throwing leverage into the use of derivatives, perhaps derivatives on very esoteric, bizarre, exotic types of instruments or underlying, entities and or products or commodities
or weather patterns.
Yeah, I mean, that starts to get that's where things start getting in trouble. I'd say more than anything, it's just good old fashioned leverage that tends to get the derivatives world in trouble. In and of itself, it has its useful function. They can have their useful function for the right purpose.
Derivatives can be very volatile. If you're buying an option to buy shares of, let's say, NVIDIA, that's going to move much more violently than just the shares of NVIDIA itself, because there's their time value. Those options expire.
Right.
And when you buy an option to buy NVIDIA $300 a share, then that means that you have the right to only pay $300 a share for NVIDIA, no matter how high NVIDIA is trading. But if NVIDIA is only trading at $285 a share and you're getting close to the expiration date of that option, those options are going to lose their value. And to Gerry's point, Gerry, did you know that part of the reason for Southwest Airlines' success has been its fuel hedging?
I don't doubt it. I mean, there's lots of companies that have done successful hedging strategies. I would caution though, because there was a company back in the day called Enron.
Ah, yes, Enron.
And for the longest time, Enron was coming up throughout the 90s. Enron was coming up through our growth screens, and we kept scratching our heads going, what in the heck is this Houston utility doing that they're making so much money? And dig deeper, find out that what they were really doing was just trading energy contracts. I mean, it wasn't, this sleepy little utility got, for a while, the advice to go out and play the energy futures game. And eventually the rest is history, and it backfired on them big time. And then, they tried to cover it up, I guess. And that's actually quite a sad and tragic tale. We won't get into that, but my point is that there's an example of where it can run awry. It can really cause problems, and it usually has to do with leverage. There are people borrowing to do. I mean, it's already, Doug just mentioned the level of volatility that you live with in the futures and options on futures and options on stocks market, right? Because it's a time value that ticks away. They all have an expiration date on them, and they're usually in a matter of months, maybe even weeks. It could be it's expiring tomorrow, and you're really taking a flyer. I think something's going to happen with this tomorrow, and I'm buying an option that's going to expire tomorrow. I'm buying a future that's going to expire tomorrow, and boom, then it's gone. Your money's gone if you bought a contract on that. There's a reason. It's kind of similar. There's an analogy to the life insurance, the whole life insurance, commentary we made earlier. There's a reason why the people who make the most money in options are the people who sell the options, or what is another term for selling an option is writing an option. In other words, they're the creators of the option. They're the one that's saying, so you think NVIDIA is going to go from 350 to 450 over the next 3 months? I've got an option for you. And they sell it to you for $5 an option or whatever it is. I'm making this all up out of thin air. And then you wait, and you wait, and you wait, and wait, and wait, and 3 months later, NVIDIA is only at $400 a share. Darn. Well, thank you very much. I don't owe you anything. You bought that option from me. You gave me $5 for it. Sorry, but it's not in the money, and I'm going to walk away with my $5. I think it's something like 95% of all options go unexercised, maybe even higher than that. So the people that really rake it in that game are the ones that are writing options or selling options, and get the suckers that think they're right about something going up or they're right about something going down. Obviously, there's a high risk in that to the extent that if it does work against them, then they're going to owe a bunch of money.
Yep. It's like not buying life insurance. You can save money on premiums by not buying any life insurance, but if you die, then something your family's in a bad way.
We're all going to die.
Yeah.
If you can reach an untimely death. Anyway,
well, tying that back into life insurance, though, again, I read and I corroborated this, that a pretty healthy portion of the benefits provided to the ex-Enron executives was life insurance policies. So that's not a commentary on the ethics of life insurance. I just point out that whether you're a saint or a scoundrel, life insurance has been used by people for creative estate planning and for juicing up compensation. So the fact that their life insurance policies were part of the compensation has nothing to do with the ethics of what Enron was doing to make that money, mind you, which was completely smoke and mirrors, as derivatives sometimes are.
And I urge people to look into the actual story behind the Enron, because there's much more to it than meets the eye. And I suspect, we won't get into the details, but I suspect there were probably a lot of folks that ended up going down with that really didn't deserve to. Maybe they were guilty of being gullible. But it was quite sad. It was a very tragic story.
Definitely very tragic. And part of the problem, I think, is that people didn't ask questions because everyone was making money. Yeah. So I think there are obviously a lot of people who willfully misled others. But
that was one of the things that I point to in our history of portfolio management, where we just finally just said, there's no way this doesn't make sense. When we tried.
Did you look at Enron?
Oh, hard. And we came close, but still couldn't get past that. This just doesn't make sense. And we've seen a few others since then, names not mentioned, that had similar kind of situations that it's just like, no, this is not their business.
Not to put you on the spot, but can you think of an example, maybe you can't, of a company where in the moment you were thinking, this does not make sense, and then in retrospect, it turned out to be totally legit and it did make sense? Or is every time your spidey signal's gone up, it's been...
I have to say that, no. I mean, it's not to say that we passed on things that we wished we hadn't in retrospect, but not because we thought it was, not because we thought it didn't make sense. It was just because we were like, well, I don't know that that's a business that I want to be in. A mistake. Usually it was because we overthought it and it was too simple. And we thought, can they really, is this really going to be anything all that special? And then, it turns out to be really good.
But you've never had the reverse Enron where it's like, oh, this doesn't make sense. And then in retrospect, it's a...
No, when we have smelled a rat, we've been right about it.
Okay. Gotcha. So not too many false positives on the smelling a rat.
No.
All right. There we go. Again, with the obligatory. Gerry, anything else you want to say about derivatives or life insurance or Enron?
No.
Or fraudulent businesses?
I think we're good.
Thanks. that brings us to the close of today's show. Please remember to view us. Well, you're viewing us here on YouTube. Like and subscribe. Also, tell a friend. Instagram, taylorforgone.invest. And, of course, our website, taylorforgone.com. Until next week, I'm Doug.
I'm Gerry.
And have a blessed Advent, and we will see you in 7 days.